Chevron Corporation, ticker CVX, is paying about 4.3% dividend, or $6.52 per year. The stock is about flat in 2024 and down about 10% in the past 12 months. In this video, I'll show you how I use covered call strategy to more than double my yield on the CVX stock that I own, as well as talk about future prospects of this company. Okay, so let's get straight into the main topic of this video, and that's supplementing your dividend income with covered call premiums. Okay, so what are covered calls? Basically, covered call is an options contract where you sell an option to buy your shares at a specific price before a specific date or on a specific date. Okay, and for that you collect a premium. Now, for example, we can look at this options chain here, and you can see if we go to May 17th, right now is March 6th, so that's about 2 months and 10 days out. So today you can sell a $165 options contract. So this $165, that's the strike price, and you can sell it for $1.35. Okay, so options contracts are always traded for 100 shares per contract. Okay, so you need to have 100 shares of Chevron to sell covered calls. Okay, and so basically, if you sell this contract right here, you agree to sell 100 shares of Chevron for $165 on or before May 17th. All right, so right now, as we can see, Chevron is trading at about $150. So you would collect about just under like 9.9% for 2 months and 10 days. And then if you're assigned, then you will collect another 10%. Okay, so your total income, if you sell this contract, would be 10.9% in 2 months. If the share price of Chevron does not reach $165 before or on this day, May 17th, then the contract expires worthless. You get to keep your shares and you get to keep the premium. And if you get assigned, that means if the price of Chevron is above $165 or above the strike price on May 17th, so you have to sell your shares for $165 because that's the contract strike price. And if, for example, Chevron is $180 on that day, then your maximum upside is capped at $165, so you don't get that extra $15, for example. However, if we look at the share price of Chevron, it's been kind of range bound for the last 2 years. So the most it was is $185, and that was about a year and a half ago. Okay, but since then it was kind of peaking at 170 and staying mostly below that. Now, would I be afraid of getting assigned? I'll tell you, I am not afraid of getting assigned, and I'll show you. So if we look at the screenshots right here, so in August I sold $165 strike price option for $1.75. So I collected $175 premium, and then 2 weeks later I was actually assigned. So I believe the Chevron price on September 8th was $168. So whoever bought my call was basically making profit of $1.50 per share or something like that, $1.25. Let's look at the price. So if we look again here and we look at September 8th, 60. So it was above 165. All right, like 166, 167. It was in that range. But basically, the price was above the strike, and so I was assigned. Okay, so if we go back here, so my actual sale price was $166.75 because remember I collected $1.75 premium per share. Okay, so we'll go back to this options chain. So this $1.35, that's what you collect per share. So if you sell this contract, you collect $135 because one contract is for 100 shares. All right. And so I was assigned. At the time, I had only like 102 shares. So what I started doing is I started accumulating again, and mostly at a lower price. And right now, my average is $153. Okay, so I'm basically about $12 below my assignment price right now. And I have a little bit more than 100 shares right now, 145 to be exact. Right here is my share count. Now, technically, I'm a little bit down on my position, minus 355. However, if you look at this is just part of my dividend history. So I've been collecting dividends from Chevron for a while, since like 2021. And on top of the $12 premium that I run right now, I also collected a bunch of dividends, and I also keep selling covered calls, and I sell them when the price of Chevron goes up a little bit. So for example, over here I sold the 165 call for 106, and then just 5 days later I bought it back for $29 because the price of Chevron dropped. So over here I collected about 77 dollars, and then later in February I sold it again for $1.63, and a couple days ago I bought it back for $57, so I collected another $106 premium. Now in between I wasn't selling covered calls because the share price of Chevron was kind of down and I didn't want to sell. So if you look over here, it was really low in between here, so I sold over here somewhere, then I bought back 3 days later over here, and then the share price of Chevron dropped, and then it started rising again, and I sold somewhere over here. Okay, and so just over here, within a month and a half, or within 2 months, I collected basically about $200 in premiums on 100 shares of Chevron. Now, how much does Chevron pay in dividends? We can look over here. So these are the dividends that were already paid, and this graph also shows you the dividend yield curve. Okay, so this is the price, this is the yield on December 11th, 2023. Okay, because it takes into account the share price on that day and the dividend. However, if we scroll down a little bit over here, you can see Chevron just raised their dividend, and so the next payment, which will be in a couple days, will be $1.63. So basically every 3 months you collect about $163 for every 100 shares of Chevron that you own. And if we look over here again, I collected more than almost $200 in 2 months just in premiums on my covered calls. And so again, I could go ahead and sell May 17th, so that's 2 months out, $135. However, I'm going to wait a little bit because I feel like Chevron is a little bit underpriced. When it goes to 155, I'll probably sell $165 call, couple months out, maybe 1 month out, and collect another $160, $150 in premiums. And if I get assigned again, I am not afraid because I will just rebuy those shares once the Chevron price drops. Now, will it drop? There is no guarantee. And let's talk about that. So what will be the price action of Chevron or CVX going forward? So if we look at historic, let's say last 2 years, it rises, it drops. So here in the middle of the summer of last year, as oil was peaking at like $125, the Chevron price actually dropped to 137. Then it rose 164, then it dropped again, then it went all the way up to 185. However, here the oil was already below $100. And so I have no idea why people were continuously buying it. But after that, it's been going down and down and down. And so a good indicator for me of what's going to happen with Chevron price is Warren Buffett. Okay, and if we look over here, this is the Warren Buffett's Berkshire Hathaway Chevron holding. So right now, Berkshire owns a lot of they own almost 7% of all Chevron shares. Okay, and their position, if we look over here, it's the 5th largest position for Berkshire Hathaway and makes up 5.41% of Berkshire's holdings. Okay, they just added 14% to their holding, and that moved it up above Occidental. Maybe it was above Occidental. So you can see Warren Buffett opened his position in 2021, and he bought like 50 million shares. Then a couple months later, he actually trimmed half of his position. Then it kind of stayed flat, a little bit accumulation toward the end of 21, a little bit more accumulation. So he didn't even get back to his original position until next year, until May of the next year. And here you can see he actually tripled his position in May. So let's look at the price of Chevron in May 2022, and over here. So Buffett accumulated somewhere over here, and then it skyrocketed to 176, then it dropped. So we're not going to follow this closely, but he had a huge position on it until February of last year. Okay, he had 162 million. So his position with Chevron was even larger than it is right now, a year ago. So what happened a year ago? It was very high. It was 174, and that's when Buffett decides to start trimming his position. He sold about a quarter of it, then he sold a little bit more, sold a little bit more. And over here in August, I think, So it was $160. He probably sold somewhere over here, which is not good. Then it went up. He sold some more as it went up, and he didn't make a move on it for like a whole quarter. But then this year, you can see it bottomed out at like $139, maybe even lower. Like this shows 142, but it was actually lower. If you look at daily, yeah, about $140. That's where it bottomed, and so Buffett started to accumulate more. So why I'm discussing this? So basically, I think that Chevron price is not going to make these huge moves to $180 anymore, or at least not anytime soon. And oil price is a good indicator of that. And if we look here, the oil price right now is, let me zoom in, 78.50. Okay, and it's way down from 125 that it was in the summer of 22. And what do I think will happen to the oil price? I actually have no idea, guys, what will happen to the oil price. However, what I do think is that oil price, if we have a recession, it will actually go down like a rock. If we look at oil price, let's say 5-year chart. So no, let's actually look at all time. So right now it's actually above the median for the oil price. I think median price for oil is somewhere around $65 over the last, say, 25 years. Okay, it goes up, it goes down. However, when it goes down hard. And I don't know what you think, but I think we will have a recession. Now, if you don't think we'll have a recession, you think economy will improve and there is a shortage of oil, so then oil will likely go up. If you think like China will finally reopen a year after Corona, then they will start buying oil. But China is on the brink of massive collapse. Their real estate market is in dumps, and 70% of all household money in China is in real estate. And they're like almost every day you hear their huge developers are declaring bankruptcies and are not paying on their bonds and whatnot. So I don't think China recovery will happen anytime soon. And I think even in the United States, we probably will have a recession. So I think the oil price will go down in the near term, a couple of years. Why do I say that? Because yes, the job market is tight and the unemployment is low. However, what they don't tell you when they post those unemployment numbers is that a lot of those jobs are created by the government, so they do not add to the GDP. They do not produce anything. They're basically like government is hiring bureaucrats. They're buying votes with taxpayers' money. That's how I look at it. And then they revise the numbers down, but without a lot of fanfare, just quietly do it on a Friday before everybody goes on, their weekend things. So nobody even checks that government has quietly revised the numbers down. So bottom line, I don't know if we'll have a recession, but I think we do. I think we will. And if that happens, the oil will drop below $50, in my opinion. And prices of Chevron will go down to about maybe 110, 120, maybe even below. And should you buy Chevron today? I don't know. This video is not an investment advice. I'm just telling you what I do with my shares. And I had a luxury or a luck to start acquiring my shares right over here in February. And my initial price was $89. I held on to my 100 shares of Chevron for a few years. It ran up. I was selling cover calls. I was collecting dividends. So I am not afraid to lose my shares because I know that my initial buy price was pretty low and I can trade in and out. And if we look over here, yes, my average says right now $153. However, that does not include the profit that I made on selling the shares when I was assigned. Okay, and there's also a bunch of dividends. So my actual cost per share, after we include all the covered call premiums and all the dividends that I have collected, it's below $80. So basically, I don't know where the Chevron will go, where their price will go. However, if we look at Warren Buffett, he is buying, he's increasing his position. You have to keep in mind that Buffett is not afraid to sell when the price runs up. He trims his position, and when the price goes down, he accumulates. And that's what smart investors do. And I was lucky, I'm not calling myself smart, but I did accumulate Chevron somewhere over here at $89. So that was my whole thesis in the previous video that I made, should you buy oil stocks right now? And basically, the idea is that when there is a recession, when the price of oil collapses, that's when it's time to buy the shares of oil companies, not when they're at the peak levels or near peaks. However, as you can see, Buffett is increasing his position in Chevron, so he is bullish on it and he is increasing his position in Occidental Petroleum. You can see it's his number 6 position. So number 5 and number 6, or total of almost 10% of his portfolio, is oil stocks. So he's bullish on oil, and overall I'm also bullish on oil, just not at current price. I think there is a chance that Chevron will drop to $120. So a question is this price 150 justified? And let's look at their earnings. So this is when the price of Chevron was, actually here it dropped, but later over here it was actually at $185, which is insane because their EPS started dropping already. And if we look over here, earnings per share and free cash flow, their free cash flow is often higher than the earnings per share. I'm not sure exactly how they calculate. Here it was actually 0 for some reason. But anyway, let's look at their revenues. Okay, so their revenues are pretty flat for the last 10 years. So 10 years ago in 2014, it was 50 billion. And last quarter they reported about a month ago was 47 billion. So, and it's been flat for the last 20 years, more or less. So it goes up and down. But over here, 20 years ago, it was 48 billion. And last year it was 47, last quarter was 47 billion. Let's look at share price for 20 years. So 2004, and over here the share price was $61 on the same revenue. So even lower, like 55. Yeah, this is weird. Like, I think it's really overpriced right now. Let's look at their earnings per share during the same period. EPS, let's go 20 years ago. Okay, so their earnings per share was $2, and before that was in a $1 range, and right now it's like $3.50. So yeah, that's why the share price is so much higher. Now this last quarter was $1.20. So I think part of that is the investment they made or whatever, because the earnings per share is not the only indicator of the company's strength. However, their revenues are not growing. Like, yes, they went up over here when the oil price was very high, but over here it's already down to the level of 10 and 20 years ago. However, their EPS is growing. Their number of shares is slowly decreasing. You can see over last year they bought back like 2.7% of their shares, but over last 10 years it's basically flat. It's about 3% for the whole 10 years, or 3% for the whole 10 years that they were buying back, because over here they were issuing new shares. However, guys, their dividends, they've been paying dividends for more than 50 years, and they're always growing. I think over here this is an anomaly. I'm not sure what this was, but you can see some years they maybe don't increase it, so they may skip a year, but they never cut the dividend. It's always going up, and they just had a massive increase. You can see over here they just increased it by 8%. So this is way above the rate of inflation, at least the one that government reports. And over the last 10 years, the dividend CAGR is 5%, which is also above inflation. This is a very good sign. Now let's look at the dividend safety of Chevron. You can look over here for the last. So this is Corona. We kind of have to discount it because the oil price, they lost a lot of money during Corona. All oil companies did. Exxon, Chevron, all the smaller guys. So over here, this quarter, their payout ratio was 180%. However, it quickly went down below or around 50%. So here it's like 23%, 24%. Right now it's reported at 123 because their EPS last quarter was $1.20 and their dividend is, at least for this quarter, $1.51. You can see over here, dividend $1.51 and EPS 120. So the dividend payout rate is 123%. But you have to look at the bigger picture. They have a ton of cash. Yes, they do have debt, but they can pay it out pretty quickly. Like, I think within 1 year in net, they make like $6.5 billion per quarter in net income, and they have cash. So in like less than a year, they can pay off their debt, and they probably will not do it because they use debt. So another metric I like to use for dividend safety is dividend to free cash flow. So free cash flow is how much money the company actually has after all the expenses are paid, and they pay dividends from the free cash flow. This is how much they have at the end of the day, and you can see the last couple of quarters, I don't know why it's so up over here, so high over here. They have technically a negative or a zero free cash flow. This might be an anomaly with our data supplier. I don't think it was actually $0. I think it's more. So this number is inaccurate. But right last quarter, their free cash flow was almost $4 per share, and their dividend is $1.63. So it's a pretty safe dividend payer. Yes, when the oil market goes down, when there is a recession, they start making less money. As you can see over here, during Corona, they were just like in the dumps. They were losing billions of dollars per quarter. However, overall, they are a very safe business. So my only concern is if we do have a recession, I am afraid that the share price might drop significantly, probably below $100. And that's a decision that you would need to make for yourself. We're not giving an investment advice here. And so overall, in 10 years, this company has returned 101%. And if you were selling cover calls, you would probably be somewhere around 220, 230%. And this considers dividends being reinvested. So on this chart here, you can see there's two lines. The top line, the darker one, is with dividend reinvestment, and that's 101% return over 10 years, and without dividends reinvested, so just the increase in share price and the dividends collected, that's 75% return. Is it good? So if we compare Chevron to S&P 500, you can see that S&P 500 returned 221%, and Chevron returned 100%. And you can see there was a time when they were close over here in November when the price of Chevron topped at 185. But overall, throughout this last 10 years, S&P 500 returns more. However, S&P can have a massive dump. Now, right now, most of these gains in S&P 500 are from the Magnificent 7 stocks. So this is not very sustainable. If we have a correction, S&P will dump, and Chevron may or may not dump. And if we compare this to ExxonMobil, Chevron did a lot better than Exxon in the last 10 years. So you can see Chevron returned 100% over 10 years, and Exxon, with dividends reinvested, returned 73%. And you can see most of the time Chevron is actually above ExxonMobil. And the reason for that is the share price that they had 10 years ago. So you can see 10 years ago, Exxon was 115. Chevron was 115. And Exxon was 93. So it had a very minor price increase over the last 10 years. In fact, over the last 20 years, it had a minor price increase. And Chevron did a lot better over the last 20 years. So you can see it almost last 20 years, it basically more than double. And so what I want to do now is simulate buying 100 shares of Chevron and selling covered calls as well as collecting dividends and using the money that you collect from covered calls to buy more shares of Chevron. So let's do that. We will load the stock, CVX. Okay, so here's our latest share price, latest dividend, and the dividend CAGR, or the rate at which the dividend is growing, as well as share price CAGR, or the rate at which share price is growing. Okay, so now this extra investment, $100 a month, let's say that we can safely collect about $70 in covered call premiums every month, and we need 100 shares of Chevron, so let's make it an even $15,000. Okay, let's calculate. So over 10 years, if you invest $15,000 right now, the potential is that you will end up in 10 years with almost $43,000. Now, because the premiums for the stock will grow together with the share price, I would probably go safely somewhere at about $75. Let's call it $80. That's how much you can realistically collect from selling covered calls. Okay. Now, again, you can actually go with a lower strike price to collect higher premium, but I prefer not to do that. So I usually go 10% out of the money. And so if you realistically can collect about $80 per month and reinvest it into the stock, then after 10 years, your initial investment would be almost $45,000. So that's almost 200% return on your investment over 10 years. Okay, I think that's pretty good. And then, like, these are the numbers. So you end up with you start with 100 shares, and then after 10 years, you would have about 217 shares. Your yield on cost by then would be 8.7%. However, keep in mind, this calculator doesn't know that the $80 comes from selling covered calls. So it calculates your yield on cost based on additional investment. So if you click here, you see your initial investment in the first year is almost 16,000, and then after 10 years, it's calculated at 24.6. And so your yield on cost is calculated based on your actual investment. However, because this is your covered call premiums, the yield on cost would actually be higher. All right, YouTube, thank you for watching. And I'm Leo with DripCalc, and I'm using our DripCalc Pro software to basically do all this research on the stocks. If you're interested, we just launched this software, so we are running a promotion where you can get lifetime 30% discount if you sign up for it, and I will put a discount link in the comment section below and in the description for this video. Thanks for watching. If you have any questions, feel free to ask them in the comment section, and let me know if you like this video, if you want me to make more of this, and I'll see you in the next one.